We're going to think fast today and look at Darden Restaurants, Inc., the world's largest casual dining restaurant chain with over 1,900 restaurants, and look at it from the perspective of the business only. What we see here is a plotting of their earnings per share since being spun off in May of 1995 by General Mills and then becoming an independent public company. As you can see, earnings growth has been very excellent. There have been a few periods of flat or even a down year initially, but all in all, you can see they've grown earnings at over 13.4% on an annualized basis since going public. Next, we want to add dividend income to the equation here because you can see the light blue shaded area shows dividends paid out of the green shaded earnings. And Darden did pay a dividend all during this period of time, but it was very modest until 2005, where they made a major inflection point in how they treated their shareholders via dividend income. Not only did they increase their payout ratio, but you can see that the amount of earnings that they've paid out in form of dividends has increased dramatically, depicted by the light blue shaded area. Finally, we're going to add monthly closing stock prices to the equation to show how closely Darden's stock price, which is the black line on the graph now, these are monthly closing stock prices, has correlated to and tracked earnings over this time frame. There were periods where it got a little overvalued, for example, in January of 2002, but then they quickly moved back to the earnings justified value. And then in 2008, even though earnings held up reasonably well during the Great Recession, the stock price fell precipitously and before eventually recovering back to its earnings justified value. The stock is currently undervalued today, and after falling 11% today, we think it represents an excellent buy, which we'll be talking about here in a second. When you evaluate the performance that Darden Restaurants was able to generate on their shareholders' behalf, you can see that a $100,000 investment when they originally went public in 1995 would have grown to $650,000 in this 16 plus or almost 17 years. Plus they paid about $72,000 in dividends over that time frame. So not counting reinvesting their dividends, their total annualized rate of return was 12.7% versus 6.7% for the average company or the S&P 500. What's important, as we've previously mentioned, to notice here is the big change that they made. Their dividends were, growing modestly during this period of time, but they went from 8 cents a share in 2004 to 40 cents, and you can see that their payout ratio was ratcheted up dramatically also. So they went from being almost a pure growth stock up to 2005, where they sort of morphed into a dividend, growth and dividend income stock since that time. Now, as we move to looking to the future, prior to today, where they kind of altered their earnings and revenue guidance, the consensus of 30 analysts reporting at Capital IQ were expecting 12.5% estimated earnings growth. They were expecting $3.81 a share this year, $4.30 next fiscal year, and then earnings to grow by 12.5% going forward, which would have represented about a 17.8% rate of return by going out to fiscal year end 2016, assuming they hit their earnings targets. However, as a result of some weakness with their Olive Garden chain, the company altered their guidance and lowered it. They're now expecting $3.65 for 2011 and $4.08 for 2012 based on their guidance. So we're going to use the override feature of the Fast Graph research tool here and look at what it looks like with these adjusted numbers. What we really want to point out here, now that we've adjusted these numbers from 381 to 365 or from 430 to 408, nothing really has dramatically changed here. The rate of return would now be expected to be 16.8% annualized, assuming that the company hits its target, earnings growth of 12.5% and resumes that after a slow year this year. So if you looked at putting 15 times earnings on May 31st, 2017 fiscal year end, you would get the 16.8% compounded number, or a $98.02 stock price for Darden Restaurants. The point is that, the slight adjustment for this year and next year's earnings, we don't believe warranted an 11% drop in the stock price. The stock was already undervalued in our opinion. We believe its intrinsic value, even after these adjustments, is over $50 a share, closer to $55. And as we previously mentioned, $98 a share by year end fiscal year 2017 or May of 2017. So what we think we see here now after today's 11% drop, which, by the way, brings the stock to only $42 a share approximately, represents a great buying opportunity at this point.